Hi everyone and welcome to In the Money. Apologies that it's been a few days since the last video, but my boss was in town, and you know how that goes. Anyway, I hope you will appreciate some of the upgrades that I am bringing to the channel based on your feedback. In today's video, we will continue with more educational content. Previously, we discussed the differences between futures and options. We will now look at forwards, which represent another class of derivatives very similar to futures, but they have a few notable differences. Since a video on forwards versus options would be very similar to the video on futures versus options, today we will look at the differences between forwards and futures. Recall previously that a futures contract is an obligation that both the buyer and seller are required to honor if they hold the contract through till expiration. The price of the forward contract is established at the beginning of the contract and is called the forward price. The forward price is related to the price of the underlying asset at initiation, plus a cost of carry component. Before introducing forwards, remember what all derivatives have in common. They are used for speculating, hedging, and arbitrage. Let's illustrate how futures are used for speculative purposes. Suppose a trader is very bullish on the price of crude oil. It is now February, and he expects the price to rise significantly by end of June. There is a June crude oil futures contract trading at $75 per barrel, and the trader decides to buy the contract. Remember that by using a futures contract, the trader can access the crude oil markets and is able to stake a position with only a relatively small amount of capital. Crude oil in the futures market is traded in increments of 1,000 barrels per futures contract. Therefore, the investor has a position worth $75,000 because he has control over 1,000 barrels at $75 per barrel. The broker might only require 10% or $7,500 of initial margin to facilitate the trade. Between February and June, the price of crude oil moves around due to geopolitical events and supply pressures around the world. The futures contract price also moves around in the same direction and magnitude as the price of crude oil. If there are big shocks to crude oil prices during the time between February and June due to turbulence in Russia, the broker may require additional margin to be posted, also known as maintenance margin. This is to protect the broker from any volatile price moves that could expose the broker to margin calls. That is a whole topic for later. Suppose we're now in June and the contract expiration is fast approaching. It is traditionally the third Friday of the month, which is the 16th of June, 2023. Suppose the price of crude oil has risen to $100 per barrel. The trader does not want to receive the physical delivery of crude oil, so he decides to exit the position and receive cash for his correct trading idea. To close the contract, he has to sell it back to the broker. He earns $25 per barrel of oil, which translates to a profit of $25,000 less any fees or commissions. Not a bad profit for an initial position that cost him $7,500. However, suppose things played out differently, and instead of rising to $100, the price of crude oil fell to $50 per barrel. In that instance, the trader would have lost $25,000 and his initial trade thesis would have been proven wrong. To show an illustration of hedging, suppose we consider the other side of the same futures contract. Suppose an oil company has a huge inventory of oil and is worried about a drop in crude oil prices over the next few months. The oil company can sell a futures contract that will profit in the event that oil prices fall. This effectively hedges or locks in the price of crude oil for a portion of the oil company's inventory. If the price of crude oil increases from $75 to $100 per barrel, the oil company would be worse off by $25,000. However, if the price of crude oil fell from $75 per barrel to $50 per barrel, the oil company would earn $25,000, which would offset losses on 1,000 barrels of crude oil. Forwards are functionally the same as futures. The buyer and seller are obliged to either buy or sell an underlying asset at a future date at a predetermined price. The main difference between forwards and futures is how they trade. A futures contract is standardized in terms of the quantity of the underlying and is available for trading on exchanges. A forward contract is traded over the counter, meaning it is a customized contract that is traded between two parties directly, without the use of an exchange. The two parties agree on the terms of the arrangement ahead of time. The bilateral nature of a forward contract means there is less oversight over the trade, and the two parties are exposed to more counterparty risk versus a futures contract. In a futures contract, there is little risk that the contract will fall apart due to the creditworthiness of either party, since the exchange would have to become insolvent in order to have counterparty risk. The futures market is scrutinized by the Commodity Futures Trading Commission. While there is little regulatory oversight over the forward markets, the customized contracts in a forward contract mean that the terms are more flexible than for futures. This makes them better suited for large institutional investors to be able to match more closely their risk profile. Forwards are not typically available to retail investors. Another critical difference between forwards and futures lies in their pricing. Since futures contracts deal with the exchange, they are priced daily. Technically, this is considered daily settlement and is known as marking to market the contract. It means the market value of the contract is calculated at the end of each trading day, and there is a gain or loss to the buyer that impacts their margin account size. In a forward contract, there is only one settlement date, which is at expiration. Let's consider the differences between forwards and futures using an example. Suppose we have a futures contract on the price of a home. The price of the home is currently $500,000, and we are worried about a downturn in the real estate market. In this hypothetical world, there is a futures contract on the home with forward price of $500,000 expiring in 1 year. Suppose there is also a forward contract in the over-the-counter market with a forward price of $500,000. As the owner of the home, we would hedge the possibility of our house falling in value by selling a futures contract or a forward to effectively lock in the price of the home at $500,000. If the price of the home goes down to $450,000, we would receive $50,000 cumulatively from both futures and forwards. However, the mechanism for receiving the $50,000 would be over daily increments in the case of a futures contract. The daily settlement means we would be required to pay our broker on the days when the market goes up or receive money from the broker on the days when the market goes down. This would happen all at once at the end of the contract in the case of a forward. I hope these concepts make sense with the visual aid I have included. Tomorrow we will return to market events over the last week and tradable ideas. If you enjoy this content, please subscribe and leave a comment for how we can improve these videos.